Hey, good morning, everybody. Welcome back. And it is Saturday morning, and this is Multifamily Live. Glad that you're here today. Looking forward to today's show, that's for sure. So, if you are new to the show, go grab a cup of coffee, buckle up. You're going to want to sit tight because we are going to get into some great multifamily conversation today. We're going to talk about private capital and raising private equity, and I'm excited about my guest, that's for sure. Remember, what are your intentions? I named my company My Core Intentions because I think everybody needs to be intentional. We need to be intentional about what we're doing, how we're starting our day, how we're progressing. Is that intentionality going to move you forward in what your career, what you are trying to do personally? I always tell people, I say, we don't grow personal or professionally till we grow personally. And so it starts with our intentions. So is it around education? Is it around listening to something, reading a book, taking action, right? Our intentionality is all based on the actions that we take once we set those intentions. So maybe it's more another sales call. Maybe it's visiting another property to find a seller who's willing to sell. Maybe it's talking to another investor about raising capital and building your database. Whatever that intention is, make sure that you write it down and take action on it throughout the day. Those are the tasks, are the things that we work on that help us grow. My guest today, Lee Johnson. Lee is with Value Investment Partners out of Virginia. We'll get to Lee in a minute. First, a little commercial about the upcoming Multifamily Summit, October 20th through the 22nd. I am super excited about this year. I can't believe the stage. We're going to have almost 30 speakers. I have 3 panels over 3 days. I have 20 speakers on the main stage. Brian Alfaro, Cody Laughlin with Blue Oak Capital, Abel Pacheco, Bronson Hill, who's going to talk about raising capital. One of the big things in the multifamily space is raising private equity, right? Building relationships. Bronson's going to really dive into that. We have Karen Hall. She's going to talk about IRAs and using your self-directed IRA to invest in real estate. So if you're new and you're a passive investor and you want to learn more about that, she'll be somebody great to listen to. We've got a couple of great sponsors for the event this year. We have CRE MLS, Kurt Koff, and his new platform that he's going to be delivering, as well as Dave Mitchell, who's going to be talking about cost segregation and how that plays into what we do. And also UDirect, self-directed IRAs is a sponsor as well. And thanks to those people for their sponsorship. 3 days of virtual event. Don't miss it. Get registered. Go to multifamily.com. Go to multifamily22.com and get registered. Hey, let me bring our guest in this morning. Lee, good morning.
Good morning. How are you?
I am great. It's good to see you again. We met in Chicago, and almost a little embarrassed this morning that I didn't remember that till you reminded me. But hey, it happens, right?
That's on me. I didn't leave an impression, so I got to work on that.
You must have, though, because I invited you on the show. So
awesome.
Well, good to see you. Hey, listen, one question I start all my episodes with, ask all my guests, and I always say, and if there's anybody out there listening who is a creative writer, I would love them to write a book for me, but I want to write a book on this one question. So in one word, what best describes you personally and professionally?
Perseverant.
Perseverant?
Perseverant.
That's awesome. What makes you persevere?
There's a rap song. I don't know if you're into rap, but there's a song that says, started from the bottom, now we here. And that takes perseverance, because where you start doesn't matter. What matters is where you finish. So perseverance is something that, I have on my wall. Oh, I think that's right on your wall as well, right?
I was just going to say, let me get out of the way, and you
move your big head.
Hey, let me ask you this: have you ever run a set of stairs like that? I think you're muted, Lee. You're muted, Lee.
Several miles. I'm muted.
You were, yeah, and now you're back. So I don't know what happened there.
Okay. So my wife and I we're into health now. You know, she has me eating a lot of asparagus, a lot of spinach, and all of those things. I'm drinking a gallon of water a day. You know, I'm just trying to stay fit, right? You know, because nothing happens. It makes no sense to do all of these things and to not be able to enjoy it. So health is something that I'm focusing on in a major way.
Yeah. Hey, when somebody tells me that they're drinking a gallon of water, I have to ask, are you doing that 75, that hard 75? Do you know what that is?
No,
So,
it's just that, you know, go ahead.
the hard 75 is you drink a gallon of water a day, you work out twice a day, you're supposed to read 10 pages in a book every day. And, of course, eat only 2,000 calories in the midst of that. And the composition of your body over a 75-day period will drastically change. So you have known a few people who've done that program, and it always amazes me when you see them a couple months later and you go, wow, what happened to you? So
No, my doctor told me that weight management is a simple thing. And he said there are three W's, right? One, he said, walk at least 20 minutes a day. And I'm walking now an hour, sometimes running, right? He says, drink water, right? And the other W is avoid whites. So avoid rice, avoid breads, avoid all of these different things, and I'll be good to go. So that's what I've been doing. And, you know, year over year, 19 pounds down. And it's a lifestyle thing for me, right? So I have my cheat days every so often. I, go and get me a milkshake because I'm a big fan of ice cream. But, I try to keep it simple. I'm in IT, and one of the first principles that I learned in architecture is keep it simple because it's going to get complex all on its own. So I try to keep it simple. So he said three W's. I followed the three W's. 19 pounds later, I'm continuing to follow it because it's a successful system that works for me.
awesome. Good for you. So, you kind of alluded to a couple things about architecture and that. Why don't you tell us a little bit about your background and how you got into the multifamily business?
Yeah, two totally different worlds for the most part. Um, my career, I'm a computer science graduate. So in 1998, I graduated from a small private university in New Jersey called Fairleigh Dickinson University, right? So we are the Knights, as they called us back in those days. After that, just had odd jobs here and there. Early in my career, I was in search of money, right? I wanted to make as much money as I could, as fast as I could, right? So I basically studied every certification that there was, took every exam that I could take. So right now, if you look at my resume, I probably have 17 to 20 different certifications, right? I've always been in consulting for the most part. So being in consulting, I was not only able to travel to many of the states in the United States, I probably have touched probably 30 of the 50 states in the United States. And I've been able to travel abroad. So I spent 5 years in abroad, 2 years in Africa, where I met my wife in South Africa. She's from Botswana. We did another stint in Singapore, and we ended off that trip traveling between helping Costco to implement their SAP solutions. So,
Wow.
so that's my career. But as I had mentioned to you, I got my start into real estate because that first time when I was out in Seattle, right? The first time that I was out in Seattle, I had gotten rid of everything. I was a recently graduated student from college, right? I got rid of my house, I got rid of my apartment, and I lived off the company's dime. But the great thing about being a traveling consultant is that there's something called per diem, right? And that's basically where they give you 50, 60, 75, $100 a day, basically for food. And they also paid for my long-term hotel where I was staying. And that allowed me to basically save a lot of money. And like most Americans, I had a number of student loans and I had to pay off those student loans. But as I was mentioning to you before we started the call, is there was a small stock guy in Seattle. He was terrible, absolutely terrible about picking stocks. He got me into a whole bunch of companies that didn't rise at all. But he gave me one piece of advice. And that one piece of advice, he says, Lee, because you are a high income employee, what you need to do is you need to buy a house. And he was telling me that I should buy the house so that I could get the write-offs, right? But lo and behold, I moved to Virginia in '99, and I bought my first house for about $112,000. By 2005, I was able to sell that house for nearly $400,000. And that was my saving grace. And when I sold that house, I not only paid off my student loans, but that was my opportunity to get into real estate at the same time.
Wow. Nice. So do you still own that house today?
I sold it. I sold that house, cashed out, and went and bought me a nice bigger house, right? But that was in 2005, right? So I bought the second house in 2005. It's of course increased in equity at the same time. But I took all of those proceeds and I started investing in Wilmington, Delaware, because the Washington D.C. area is tier one, right? So you basically have to have significant capital in order to invest in this area. So I went to where I knew and I started investing in Wilmington, Delaware. Both good and bad stories came from that because I invested with a family member and and I crashed and burned, right? There were some foreclosures and things of that sort from 2008 to 2009. But good for me is in 2010, I was out of the country for another 5 years, which allowed me not to have to worry about credit and things of that sort. And I was able to replenish my credit score. Plus, since I was traveling and getting paid for it at the same time, I was able to save up a boatload of money. So when we returned.
Good for you. Good for you. So where did you transition into multifamily?
That's an interesting question. And I transitioned into multifamily after starting a number of flips. So the part of the story where I didn't get to is, so from 2010 to basically to 2014, we were out of the country. We saved up a lot of money when we were out of the country at the same time. But when we returned, as I mentioned earlier, my wife is from South Africa, well, from Botswana, right? And she had to go through all of the things with immigration, et cetera. So we were looking at different businesses that we could purchase because I am a high income employee. So it wasn't no need to add additional W-2 income into our household. So we looked at different businesses, right? But when we looked at all of these different businesses and franchises and things of that sort, that just wasn't for us. So we took a boot camp, right, over here in Reston, Virginia, and we started doing flips. And watching TV, seeing everything that happens when it comes to flips, I was in a position where I wanted to do 10, 20, 30 flips a year, right? But if you have a W-2 income and you earn over $150,000, that's going to be a recipe for disaster, because at that point, guess what you're going to do? You're going to write a check to Uncle Sam. So after doing so many flips, right, being a hard money lender and getting into second trust position, basically that's a Boy Scout type of loan, I said that's not for me. So I wanted to buy a multifamily. Being in a tier one area, I was going to have to probably spend between $200,000, $300,000 a door on a 16 unit or 20 unit. And that's just where I wasn't able to go. But lo and behold, I educate myself all the time. I'm always in a position of learning. and I picked up Gene Trowbridge's book. It's a whole different business, et cetera, something like that.
Okay.
And that book opened up my eyes to the fact that there was something called syndications, and I didn't have to have all of the money to go into a deal. So at that point in time, I learned something new. I basically, as you mentioned, I liquidated my 401k into a self-directed IRA, and I started investing in syndications with this guy, that guy, the other guy, someone else. And that was around 2017, 2018. So most of those deals have now come full circle. I look like a rock star, but in 2019, when we were, 2019, 2020, when we were headed into the pandemic, I literally lost my cool because literally all of my retirement was invested in different multifamily syndications. And I was thinking to myself, oh, there's going to be a problem here if people can't pay their rents and things of that sort. But lo and behold, the government came through. People decided to move into the areas where I was investing, which are the Carolinas, Florida, Texas, right? Leaving New York, Chicago, etc. And I came out ahead of the game.
Wow, good for you. So you're investing then. Do you mostly invest passively, or do you raise capital and invest, with other people in other deals? Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets, just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
So at this point in time, I'm going into my 25th deal.
Wow.
So the first 20 of those deals, I was invested as an LP. And what that allowed me to do was educate myself. I was able to educate myself significantly on what's a good syndication, what's a bad syndication, how do I want to be communicated to. So when I found operators who I liked the way that they ran their show, I started building up a database where I could help people to understand what a multifamily syndication is. So the last 5 deals that I worked on, we have been on the GP side working with a partner of ours to bring capital into the deal.
Okay, great. So let's go back. I love what you just said. Let's go back and what are the things about a sponsor? So from a passive standpoint, and I think this is great because you have that passive experience. From a passive standpoint, what do you look for when you're vetting a sponsor?
Well, when I'm vetting a sponsor, of course, if you've never worked with them before, what's going to be critical is their track record, right? Their track record and their reputation is going to speak volumes, right? But one of the things that we also learned how to do because we were underwriting for ourselves is we underwrite all of the deals that we go into, right? You should be comfortable providing us with the OM, the T12, and the rent roll so that we can put it into our own spreadsheet and ask questions, right? But if you don't know the operator, reputation, right, is going to precede itself and how many X's have they gone through, right? And then, the numbers never lie. So reputation and underwriting are the 2 critical things that I would advise anyone going to go into a syndication to follow.
Have you found any sponsors out there? And, of course, we don't want to talk about any names, but have you found sponsors out there that aren't forthcoming with the information when you ask for it?
I don't want to be coarse, but hell yeah. There are number of sponsors who are terrible when it comes to communications, right? And the way that I analogize a sponsorship is this way. I'm going to give you capital. In return for that capital, I'm expecting communication and a return. Communicate to me when times are good, but also communicate to me when times are bad, right? So going through 24 syndications at this point in time, I know the operators who communicate very well, and I know the ones who are god awful in communicating. And, there are people who I would never invest with again, and they shall remain nameless.
So what is a good level of communication for a passive investor? Do you think a passive investor needs to hear from that sponsor every week, or do they need to hear from them once a quarter? What does that communication look like, and what form does it show up in?
It's an email. It's an email. So like right now, the operator who I'm working with, we're on Syndication Pro, and Syndication Pro allows us to communicate with all of our investors at the push of a button. So we're communicating on a monthly basis, even though we are sending out distributions on a quarterly basis. And that's what I like about the operator who I'm working with is the fact that we are aligned, right? It's not that we gave money and will disappear. We're going to give you money, and then the month after we close, we're going to send you a communication to say, hey, we closed on X date, right? And this is how we're going to be communicating with you on a monthly basis so that you understand, well, what's the pre-lease, what's the occupancy, how much income have we collected, and also where are we in the execution of the business plan, right? That's going to be something that's very critical in the conversation that we have, because at this point in time, I would say of those 25 syndications that we're working on or worked on, I would say the majority of them have been value add. But it seems as though now, with tough times and inflation where it is, investing in class A's and class B's kind of sort of makes a little bit of sense when you think about it.
Yeah, absolutely. And so, do you raise capital then for sponsors, or are you just deploying your own?
I'm deploying my own. So one of the things that I say, and I communicate with anyone who's investing with me, is that I'm an investor first. So what we do is we scrub deal right before we share it with our database to let others know that, hey, we found a great opportunity. And I say over and over and over again to anyone who wants to be in this business, you have to know how to underwrite, right? You have to underwrite like a professional, because many deals would come across your desk, and if you can't underwrite, then you have to rely on the information that's inside of the. And one of the things that I did mention to you, Mike, is that before I got into this, I would go on to Realty Shares, which no longer exist, and I would just download PPMs and I would read them, because before that point in time, I didn't know of any sponsors, etc. So the only vehicle that I had at that point in time was Realty Shares. And I would go into Realty Shares, I would download a PPM and I would read it front to back and educate myself. And I can remember when I met a sponsor at the Best Ever Conference in 2020, I knew a significant amount of details about her PPM, and I mentioned to her that, hey, you have this special class and you're doing different things, and of all of the PPMs that I have read, yours was the sexiest. Like, yours was different. It stood out. It was like I had become a nerd for reading PPMs. I actually enjoyed it. So
Yeah.
now if I get a 150-page PPM, I know what to look for: sources and uses. I need to look at what the fees are going to be, how they're going to distribute proceeds to the investors. So what I tell people is that I am an investor first. 20 deals that I went into before I ever had access to the GP side, right? So I'm going to make sure that the deal that we're going into, I'm also invested in that deal at the same time. We just did a deal in Tennessee where, it was a small raise, but, I just put some money into that one as well. For me, capital should always be working, right? Even if it's sitting in the bank account, you're actually losing money, especially where inflation is today. So I have a whole little crazy system that I conjured up where I always keep the money working.
Hey, so how are you looking at the market today? So, it sounds like you're like I am, a heavy real estate investor. You keep most of your assets, most of your capital, it sounds like, in the real estate space. How are you looking at the market moving forward today? There's a lot of doomsday experts out there right now, right? Saying that the world's going to
Yeah.
crash or things are going to blow up. What are you seeing? What are you looking at?
Well, we're working on a deal right now where I think the play that you have is you have to do an assumption, right? So we have a deal where we have 10 years IO and the rate is in the threes. So that deal is going to pencil out for us, and it's going to be an assumption because yesterday, right, just yesterday, well, just this week, the Fed have raised it another 75 basis points, and they also came out and said that they're probably raised by another 100 to 125 basis points in this calendar year, right? So if you had to go out to the debt markets, last week you were looking at the fives, but now you're going to be looking at the sixes. And there's the real estate cycles, right? And right now, owners, they don't have to sell, but understanding that multifamily and commercial real estate trades off of the debt. So if they're in a position where they have finance, right? They have a product that was 3 years, 5 years, 7 years, 10 years, and they have to make a move, right? Those are the people who we're targeting and having conversations with because they need to move off of that asset. But really, right now, where the debt markets are, it's kind of hard to make a deal work, especially if you have investors who you have to have, a certain preferred return or cash on cash that you're trying to reach. We just had a deal with a new partner of ours that, we had to walk away from that deal. This was going to be our first time working with them, but we had to walk away from that deal because as we underwrote it in the 4.7s and things of that sort. But debt, when you get a quote at this point in time, it was in the fives. So that turns the deal upside down, and it doesn't work in fives as it worked in the fours.
Well, the leverage has to be so low too, and
You're
it
going to come
almost,
at 65.
yeah, and it's getting these deals to pencil right now is kind of, it's an interesting process, and it seems like you have to raise more capital on deals, and that cost of equity is not the cheapest either. So it's I think that I heard somebody say the other day, and I don't see how this can happen, but somebody said that the Feds said that by second quarter next year that the rates will be back at 4%.
Mm, I wouldn't trust that because Powell came out and he basically said that there's going to be pain to be felt in the market. And we're in a funny situation to the fact of there is high inflation, but jobs are so high at the same time. So this is an imbalance. And usually, I read this morning that typically when there's a 50 basis point raise in rates, that will send the economy into a recession. Now, this is just one article. I'm sure it's going to be somewhere between 50 and 100 basis points that has to be raised before we send it into inflation. But literally, we are 300 points above where we were last year, and we're still technically into a recession. And I know many will say that a recession is two negative quarters of GDP. But there's a body out there that looks at a number of different metrics to determine whether or not if we're in a recession at this point in time. So they haven't officially called it yet, right? So we're technically not in a recession, but I hear what Powell is saying, and I read financial blog every single morning, and I think that we're heading into a recession. But I actually feel that there's some upside to investing in multifamily at this time if you can get a deal that pencils, because at the same time that rates are going up, it also means that people who are looking to purchase a home, they're not able to afford those homes at the same time. And Maslow hierarchy says that includes shelter at the bottom of the list. So people are going to have to live somewhere, right? And people are moving from states to from regions and states that are high income, high cost, to low income states. So that's why I love the southeastern region of the United States, because there are still opportunities there. But you know, I learned how to invest from Craig Haskell at Value Hound. And Craig used to always say, you have to be in a position where you can find value that others don't see. Right. So that's why I named my company Value Investment Partners, is because we learned the business, we learned how to underwrite deal. I just flew down to Houston last weekend and walked the properties with my business partner. And there are opportunities there. You just have to find the right one.
Yeah.
And you have to be in the market, players, etc., in order to find a deal for us that makes sense.
I see where the market is going to start to shift a little bit. We've come out of this bull run where it's really been a seller's market. And I think now as we move forward a little bit, it's going to become that shift into a buyer's market is going to happen. Sellers are going to have to get realistic on their prices, especially if they want to sell out of these deals. I think that there's still things that are priced so high that's part of, in order to get them penciled, you've got to get pricing in line. And I think that, there's people that have pulled back sitting on the sidelines, but there's opportunity that exists out there.
Well, Michael, this game is played off of the debt, right? No one really is purchasing multifamily without leverage, right? And the debt markets work off of a certain term. So when people are 12 months out, they have to make a decision as to what they're going to do. Either they're going to keep the asset and refinance it, or they're going to sell it, right? And we have access to data now that shows us those who are in precarious situations, or those who have debt that's coming to term soon, and we're targeting them.
Yeah. One of the things you said, you made
I'm trying to keep it simple.
Yeah. Well, you know what? Sometimes complex is good. I always believe in stretching people's minds, right? So we might talk a little bit out of box for people, but I think it helps people grow. It always helped me learn. Hey, I didn't know anything about the multifamily business when I went into it, and I learned everything along the way. Similar to you, and that's how we learn, though, stretching ourselves. You mentioned that 6%. One of the inversions in the market that doesn't make a lot of sense right now is those cap rates being lower than interest rates. And that's where the discrepancy is coming into play so much.
Oh yeah. Oh yeah. The market is upside down. There has to be a correction inside of the market so that things can normalize themselves. And those are the opportunities. Warren Buffett says, when others are running away, that's when you walk to it, right? Those are the opportunities when others are running away from multifamily. It's time to keep that powder dry, right? Because there's going to be an opportunity to catch something good. Now, we have to go into a recession before we can go into a recovery, right? And there's the four real estate cycles at the same time, but we have to go through the recession before we can go into a recovery. And that's where I'm expecting that there will be some pretty good opportunities to pick up things in the multifamily space.
So what are those 4 R's?
What, the four R or the 4 quadrants?
Yeah.
There's recession, recovery, There's not hyper supply. I forgot the third one, and I'm about to study it again. But as you're coming out, you're going into a recession. Recession leads to recovery. Then there's a building phase, right, where people start to see that there's an opportunity. Permits need to be gotten and things of that sort. New assets are coming online, and then you get into a situation where there's hyper supply, and hyper supply turns back into a recession. So those are the four quadrants, and also you have to understand the difference between the financial cycles and the real estate cycles. And we haven't had a recession since nearly 2009.
Lee, you muted
Right.
again.
So,
Yeah.
I think I don't know what's going on here. Can you hear me?
Yeah, you're back. You're back. That's good.
All right. Apologies for that. I'll have to get this set up, checked out. But yeah, you got to understand the financial cycle. You have to understand the real estate cycle, and those are the ingredients that you put into your underwriting. Right? Underwriting is part art and it's part science. Right? And you have to know what your metrics are that you're looking for in order to come out whole. For instance, we look at the debt service coverage ratio, right? And we don't go below 1.4 on the debt service coverage ratio on any deal. We have a floor for our IRR. We have a floor for our cash on cash. We only like to invest in deals where there's a preferred return, right? Why? Because I believe that LP investors are what makes this whole thing work, right?
Right.
And LP investors, if the operator is doing a great job, they're going to get paid. But the LP investors, I believe, should get paid first. Now, some people might have a different philosophy than I have, but I believe that the LP investors need to get paid first. So if there's no preferred return on a deal, we walk away from it.
As an LP today, or limited partner, what are you looking for in a return in a multifamily deal? What makes you feel comfortable knowing the environment today and where we're headed?
Well, we're always looking at the MSA, and then if we find an MSA that we like, we do a double click into the submarkets, right? But we always need to see that rents are growing. We also need to see that jobs are there. I like to have a diversity of jobs. I don't like to invest in areas where there's only one or two job pools, right? So Houston is a great area because there's just so much going on there. There's medical there, there's universities there, of course, there's oil and gas that is there. There's just so many things that are going on over there. Atlanta is a great area, especially now outside of Atlanta. But Florida is pretty hot. The Carolinas are hot and booming. The last deal that we just did was in the tri-states, right outside of Tennessee. So we always look at the MSA, and then we double click into the MSA to look at the submarkets that are showing promise. And that's where we're going to look to build relationships with brokers and property managers, because this doesn't work without a team.
Right.
And that's how we're doing it. So the funny thing about it is, it's been 5 or 6 years, but I've educated myself to the fact that, getting my hands dirty and putting my capital at risk is how I learned this business. And I don't believe that there's any other way that I could have learned it. God bless Joe Fairless and his Best Ever Apartment Syndication book. That book has been a Bible to me. It's probably the second book that I read after Gene Tobridge. Kim Lisa Taylor, she told me what I can and cannot do. And, Hunter with his Raising Private Capital book, all of those books are ingredients into what we're doing now and the success that we're having.
Awesome. Well, listen, this morning has been a pleasure. Let's shift gears here a little bit. I always like to ask 3 bonus questions, and you might have answered this one already, but what's the best book you've ever read?
Well, oh my goodness. I can't say that there's a best book that I've ever read because, there are so many. One book that I'm reading right now, and then I have a number of people who I am mentoring. The book is called Ikigai, right? And it's a story about how to have a successful and happy life. And you might recall at the beginning of the call, I had a conversation with you about all I did was seek more money, more money, more money, more money, more money. And because why did I seek more money? Because I came from a single parent household with 5 siblings, right? So we didn't have money. So the answer to me at that point in time was to go out and make as much money as I could. And I did that. But at the end of that, there wasn't happiness. There's only so many cars that you can buy, so many handbags that you can buy, so many houses that you can buy, so many vacations that you can take. And I was working with my coach, and he brought me to this book called Ikigai, and it's about a Japanese way of life. There's certain blue zones where they have people who live to be 120 years old and things of that sort. But at the beginning of that book, it talks about finding your passions, right? Finding your passions, and I say when you find your passions, you get into a state of flow. When you get into a state of flow, you develop a level of expertise, and when you develop that expertise, people have to pay you for your expertise.
Yeah.
And that's what I've done. Investing in multifamily syndication, as I mentioned, I have a little system where, when I get cash flow distributions, the next day it's going into another investment. So I built out this crazy system that we're calling the VIP wealth system, right? And we're eventually, going to write a book about it, but it's tried and tested. It's from a kid who didn't have a spoon in his mouth, and if I did have a spoon in my mouth, it was a plastic spoon that I took from McDonald's. But it's been working. It's been working for me, and I know, Mike, you give back, right? And I feel more fulfilled, more so than anything else, if I'm having a conversation with people who didn't believe that something was possible, and we can sit down, put it on a napkin, and I can show them that it is possible. I love nothing more than to have that opportunity to show people that something greater is possible.
That's awesome. There is nothing like giving back. There's so much fulfillment in that by helping other people, and that's one of the things I teach people a lot is about the relationship standpoint, and how do I give to somebody else, because that comes full cycle over time. So, hey,
They don't
favorite?
teach this in school, Mike. They don't.
No, they
They
don't.
don't
They
teach
don't.
this. No
And you know
one
what?
teaches this. And there's more fulfillment out of helping others.
Yeah,
I don't
I
know,
don't.
I had to reach a level before I got here, right? I wasn't always here,
Yeah.
but I'm here today, and tomorrow I'm going to help as many people as I can.
Good for you. That's great. Well, I'm glad to know you. That's for sure. How do people get a hold of you and find out about Value Investment Partners?
I'm on LinkedIn, Passive REI Pros, right? So that's LinkedIn. We have our website, valueinvestmentpartners.com. It translates into VIP. And, we still have telephones where you can ring us. It's going to be lee@valueinvestmentpartners.com, or you can call us on the phone, 571-444-8474.
Awesome.
That's you get in touch with me.
Lee, thanks for being here today. I'm going to move you to the back room. If you would just hang out with me for a couple minutes, I'm going to say goodbye to everybody, and I'll be there in a minute.
All right. Thank you.
Hey, everybody, that was a great show today about passive investing. And if you're a passive investor and you are looking to make a passive investment, maybe take some notes from what Lee had to say this morning. How do you look at a sponsor? How do you look at a market and then the sub-market? how do you evaluate a deal in the midst of today's market? Lee had a great point too, that we don't, even though the market is a little jittery right now, put your capital to work, deploy your capital. Don't let it just sit on the sidelines, because it doesn't do us any good. If a deal comes along and something to look at, maybe take advantage of it. So I believe that we're going to, if we're already starting to see signs of some of the greatest investment opportunities out there. I've been doing this a long time, been through a lot of these cycles, and I'm seeing deals cycle around that make more sense today. So just stay tuned. We'll see what comes up. We're going to be rolling out a couple of things here in the next month or so ourselves. And if you have questions, don't hesitate to reach out. Remember the Multifamily Summit coming up October 20th through the 22nd. Go to multifamily22.com. That's multifamily22.com. Get registered for that event. 3 days virtual, the biggest virtual event of this year in the multifamily space. Over 20 speakers, 3 panels, 2 days of, or 2.5 days of great content, knowledge, information. Look forward to seeing you there. Look forward to seeing you next week. If you are new to the show, register, like us. If you're on YouTube, subscribe to the channel. You are going to continue to get great relevant content. Have a great week, everybody. I hope you're enjoying this morning's show and guest. If you love getting content and insider secrets just like this, then you won't want to miss this year's annual Multifamily Summit. I will host the stage to over 20 of the nation's top multifamily owner-operators, where we will pour into you for 3 full days. This 3-day virtual event, October 20th through the 22nd, is committed to help you take your multifamily business to the next level. You will hear from speakers like Brian Briscoe, Abel Pacheco, and Bronson Hill, and many others. You're going to learn how to mitigate your way and succeed through the changing market environment. Register now at multifamily